Today I'm sharing my 7 favorite trading strategies for you. I'll show you the best entries, where to place your stop loss, and how to analyze price action and charts in the right way. And this works whether you trade Forex, stocks, cryptos, indices, or any other markets. So let's get into the charts. The first pattern that we are observing is the trend exhaustion, and this is very helpful to know about because it helps us understand the power dynamics between the buyers and the sellers, and also understand when a trend is likely to be over. And by the way, because I see so many people ask about the time frame, here at the top left you can see the time frame that I'm on. This is the 1 hour 1H. So what do we have here? We are starting with a very strong trending phase. The market is pushing up very aggressively, and then it's reaching here the highs, and something is changing here. We have a double top, and every time the market reaches this level, there's aggressive selling happening. You can see we have very strong selling candles, which we haven't seen previously. So as the market goes higher, what is happening behind the scenes? Everybody who is buying here and who has bought here is now sitting on some unrealized profits, and the higher the market goes, the more people are going to take profits. And when people take profits, that adds to the selling pressure. At the same time also, the higher the market goes, more people are now ready to start selling, because the higher it is, the more lucrative it is for selling as well. So we have more sellers come into the market here. At the right side here, we have a lower high, which means that the market is not able to continue the trend structure. So in a healthy uptrend, you would see that the market keeps making higher highs and higher lows, which the market is failing to do. We are pushing into a previous low here, and we are failing to make a higher low. So you could have your trading plan at this point. You will be waiting for the market to cross 137, the big round number, and that's where you start looking for shorts. If you're long at this point, you really want to consider taking profits, because the likelihood that we're going to continue a move higher is not very high. The double top and the lower high are really strong bearish signals. Here would then be a potential selling entry. So as the breakout happens, either here or here on the candle before, you want to see that the market takes out a low, because now what's happening? We make a lower high here and we make a lower low. That's a clear trend change. So here's where people would get short. Stops are generally placed above the breakout area, and then it's up to the trader how aggressive he wants to approach his trading. You could put your stop loss right above here, the previous breakout area, or give it a little bit more room. There are traders who want to play it a little bit safer, that would put the stop all the way above the high. In my experience, that's not necessary. You will obviously sacrifice a lot of reward to risk ratio. So having a wide stop means that you cannot get a high reward to risk ratio as easily. So that's the drawback. But in general, a breakout entry usually has a stop somewhere in here. And then you can see afterwards the market really rolled over nicely, and this is where the turning point happened. So it's very important that we understand to learn to spot those changes in power dynamics, and I have a few more examples for you today. Another tip here, you could use a Fibonacci for trend trading. So once we are in here, our breakout short entry, you could add your Fibonacci once we get to the A to B C move. And my last video, I talked about Fibonaccis. If you want to check it out, you can use Fibonaccis very nicely for targets, because you can see after a 61.8 retracement here on the point C, we get to the 161 Fibonacci target. So once you know your Fibonacci retracement, you can very nicely design your target here, and that will give you a huge reward to risk ratio, and Fibonacci's work extremely well for trend following. Another tip, you could also add pivot points. I am using here the daily pivot point on the 1 hour, and you can see that we have a pivot structure change on the left side. When the market is in an uptrend, you can see the market is trading above this pivot point here, the green line. But as the market changes from a bull market to a bear market, the pivot structure also changes. You can see here, after we made the lower high, the market dips below the pivot, and then we start retesting the pivot from underneath. So now the pivot is becoming resistance, whereas previously it was support. And that's a huge market change. And having the pivot points on your charts will greatly improve your pattern recognition and your chart reading abilities. And you can very nicely then use the pivot point here for pullback trading. As you know that you are now in a bear market, as we break through the structure, you can look for short opportunities along the pivot points as well. They offer great trading opportunities, and I would really recommend that you check them out. On the 1 hour, I would recommend to go for the daily pivot point. The second pattern is the triple tap, and this is one of my favorite trend patterns. And this is a pattern that shows you also the fading power. So here we are clearly in a downtrending market, but then something is changing here between the power dynamics. So when you look at the distance between the swing lows and highs, that tells you a lot. Compare that to what has happened previously. You can see from this low to this low, there's a huge distance, right? The market made a strong selling push. That's a very strong bearish signal. But from this point to this point, what's happening? The distance is much, much shorter. So not a lot of selling going on here. And then from here to here, very short distance. Also, what we have here is a very strong corrective wave. You can see the distance from this low to this high is very large, and you can see we're even breaking through a previous resistance point. So that is a sign that the power dynamics are shifting. What is happening here behind the scenes? Let's think about it. The market has been going down for a long time, so a lot of sellers are sitting on profits. So the sellers are gonna take profits at one point, which is gonna lead to a bullish push. Also, if something gets cheaper, you are more likely to buy that. That's also adding to bullish pressure. So a lot of things are coming together here, and we can see it in the price action that this is actually the case. It's not only speculation. We see a lot more bullish pressure coming into the markets. Here, by the way, you could also say that the distance here is very small here between the swing points, and previously the market was very strong. So you could say there was also a triple tap here, and I would say that's correct. But what's different here is that we don't see strong corrective waves. Not as here. You can see the corrective wave is breaking a previous high, which here never happened. We are testing a previous high, but we are rejecting it. So that's a very different point of view. So let's see what happens afterwards. We have this very nice support and resistance level that we can use. A previous swing point here, a previous support, is becoming a resistance. And what I do in my trading is I use those as boundaries. So right now, with the triple tap, I would say this is not really a bullish pattern right now because we are still trading very low and we have not broken any resistance. So as we are trading within this pattern, I would say we are neutral. And only if we get above this area, I would think about getting into a buying trade. So this would mark the barrier for me. Above it, I would be bullish. Below that, I would be more neutral. We can also add the pivot. If you're on the 2 hour, you could add very nicely the weekly pivot point here, and that gives you a great confluence. And you can see how perfectly it aligns here. And you could wait for the market also to break the weekly pivot point if you want to have an additional filter. That's also a highly objective filter because everybody is looking at the same pivot point. So what we could do at this point is have a trading plan. If we get above this area, we're going to go long, which happens here. And how does it happen? We have a very strong breakout momentum candle. So 2 very strong candles. And if we look back, you can see we have never seen 2 such a strong candles here in all of this downtrend. So that's a very big shift here. We also see that we are starting to make higher lows, which we never did. We only made lower lows all the way through the trend. So here having higher lows is a very big change. And we are breaking through the previous support area and also the pivot point. Where do we have your stop if you get long here? Your stop will be somewhere down here. Again, it really depends on the level of your aggressiveness. Do you prefer to be aggressive trader? Do you like to go for the high reward to risk ratio and don't mind maybe to even have a little bit of a lower win rate? Then you could play with a very tight stop loss. Keep in mind, your win rate is probably going to go down a little bit the more tight your stop loss is, but that's the trade-off that you have to accept. If you put your stop loss all the way down here, it's not going to be hit as easily, but of course also your reward to risk ratio will be much smaller. So you have to take that into consideration. But at this point, we really want to be long. And you can see afterwards the market very nicely trended higher. Here we are now starting to see a little bit of weakness with a double top into the market, but it could also just be our first retracement, which we have not had at this point. So those trend exhaustions and triple taps are very important because they help you first of all understand when an existing trend is likely to be over with a triple tap, and also when are we going to roll over into a new trend. And then you can find those breakout areas, those turning points. Where do you estimate that we are really going into a bullish market? And that is what you can then use for your trading plans. Here we are now having a fake out on a 30-minute time frame, and I like to talk about fake outs because a lot of traders have problems with them and they often lead to a lot of issues. But if we understand what a fake out is and what is behind it, we can avoid problems. So what do we have? We have a very strong uptrend. Then we have our first pin bar candle, which is the first sign of rejection. At this point, if we only have the pin bar, obviously that wouldn't be enough to get into a short trade because you can see we're just coming from a huge uptrend and it's not unlikely to see a little bit of selling pressure come in. what happens here, the higher we go, the more people who are buying up and down here have more profits, and then they are more likely to take profits. So that's going to add a little bit of bearish pressure. But what is happening here is really important. You can see we have a very strong bullish candle that looks like we're going to make a breakout, right? And we're staying above the candle, above the previous candle high. But within the next 2 or 3 candles, we see a very big change. First of all, volatility is increasing, which means the candle size is increasing, but also the wick size is increasing. And also what is happening is that we suddenly have huge red candles. So the red candles are very large. This shows us as well that something is definitely happening here. It could be profit taking. Everybody now is more likely, as you see more and more noise in the market. If you're in a buying trade from down here, you're not going to be super happy to see that, and that's not going to really bring you a lot of confidence in your trade if you suddenly see more selling to come. So as this happens, more and more people are going to take profits and add to the selling pressure. And also the people who are not in trades, but who maybe see the fake out and who know that there is a lot of bearish pressure, are more likely to start selling as well. So that's all coming together here. A fake out is basically a breakout. So this candle is a breakout candle getting above the high, but then we're immediately coming back into the range here. And we see a lot of selling pressure come in. We can also add the Bollinger Bands. This is the Bollinger Band here with the 2.5 standard deviation. You can see it here, Bollinger Band, 20 period and 2.5 standard deviations. And what you can see in those fake outs very often, that they also happen with a Bollinger Band spike. So this candle is trading outside of the Bollinger Bands, and then here we are immediately falling back, and we are really strongly rejecting it. So Bollinger Band spikes are often traded by reversal traders. Or if you're a trend trader, you can use them as a way to take profits when you start seeing rejections here at the outer bands. In a strong trending market, it looks very different how the market behaves with the Bollinger Bands. In a strong trending market, you will see that the market is able to stay sometimes outside of the Bollinger Band for a prolonged period of time, or at least trade very close to it. Weakness is signaled with the Bollinger Band when the market is suddenly pulling inside of the Bollinger Band. You can see that now the bands here and the price is separating. It's trading away from the Bollinger Bands. That's showing you a little bit of weakness as well here already. Here is now your breakout entry. So at this point you can see we are breaking the previous support level, and that's really what held the market here in this top pattern. And when those top patterns are broken, especially when you see it come with such a strong selling period, you can see we have suddenly a lot of selling, which we have never seen here previously. That's a big shift, and here you can very comfortably go short. Again, stop somewhere up here. You don't have to put it all the way above here, but here is probably where the majority of trades will be, and then that gives you a very good reward to risk ratio. And you can see you can use the Bollinger Bands on the way down as the trend unfolds. When you see the market is pulling inside the Bollinger Bands, then you could start thinking about maybe taking partial profits and keeping a close eye on the market, since now there's a higher likelihood that the downtrend is over and you should start protecting your profits. Let's look at a continuation pattern. And what we have here is an accumulation breakout. So what we have is a transition, right? We're coming from a downtrend on the left, then we have our range market here, accumulation, then we have our break and retest. And then once we know that we are in a trend, we wait for our first corrective wave. Corrective waves are prolonged market sideways periods. So after the trend, you will then see at one point a sideways phase where the market is not immediately continuing. Why is that so? A lot of traders are going to take profits, so people who bought down here are now having more and more unrealized profits, so that makes taking profits a little bit more likely. That adds a little bit bearish pressure. And also probably as the market moves higher, more sellers are coming into the market, because as something gets more expensive, it makes more sense to sell it, right? So that is here where we have the sideways period. And then we have to observe what is happening. Are we going to see a breakout below to the downside that would indicate a reversal, or do we see a continuation to the upside? We can add also a moving average. So here I am using the 50 SMA, the red line. You can also use the EMA, doesn't make a huge difference. And what the SMA is really good for is helping you to understand when we have a good pullback. So it could be a pullback filter. You wait for the market to reach into the moving average, and then you know, okay, now we're having a little bit of a sideways period, and at this point it makes sense to start looking for breakout opportunities. So on a continuation, what you usually would like to see is something like that. you have either the breakout out of the trend line, or you can wait for the market to break all the way and continue into a new high. At this point, it's very obvious we are continuing the uptrend. We didn't move lower, so even if it was a more selling coming into the market, the selling didn't reach a tipping point and turn the market around. The buyers came back in, and you can see we have large green candles, what happened also previously here. And on a bullish trade, on a breakout entry, your stop is usually somewhere down here. Again, you can choose to make it all the way below the pattern or somewhere around here. Again, it really depends on your level of aggressiveness. We can also add our pivot points. We are here on the 2 hour, so we could use either the weekly or the daily. But if you're using a continuation strategy, then you're usually off better with a daily pivot points. They act a little bit faster. Weekly pivots take more time to adjust since they come from the higher time frames. And what you often see is that pullbacks also happen into the pivot point. So when you can see here, we have the moving average come together with a pivot point and it holds as support. The market is not able to penetrate it and go below that. That's a very good sign for your pullback to actually turn around eventually. And if you would see the market is trading below the pivot point, that would be a big heads up. Right after this corrective wave, we have another corrective period. We move into the pivot point and we reject it. So don't worry if you see something like that. As long as the pivot and the moving average holds, usually that's a very bullish signal. If the market would fall below that, that would then be a concern, and you should think about whether you want to be in a long position or it's better to take profits. And then you can see here was our first corrective wave, here was the second correction, and then the market continued higher until here. And here we have signs of a trend change. The signs for a trend change are a pivot change, which means that suddenly the market is trading below a pivot. Whereas previously in this uptrend, ever since we broke out of the accumulation, you can see we were never able to really break below a pivot point. That changes here. Also, we have a larger corrective wave. So the market spends more time going sideways without giving us a clear indication here. Whereas here, the corrective wave 2 and 1, they took only a very short amount of time. We also see a change of the high and low structure, right? So up until this point, we make a higher low, higher low, higher low, but then suddenly something is changing. Here we are also then not as easily to complete the higher high, so we're not able to break below the high very quickly. Here we are, but then afterwards it changes. So at this point it's really clear that the market is definitely changing and it's not very bullish anymore. Also, the moving average is in the center of the price action. That's also a sign that the power is losing and the momentum is down. So the bullish power is not as strong anymore, and you can see the market is trading around the moving average. So those are all signs that a market is changing, and at this point, now it's very clear that the bullish trend is likely to go over, and as you can see here, shortly after, the market did roll over into a new bearish trend. Now we are trying to understand waves in relation to each other, and that is a very, very important concept because it really helps you understand what is going on here behind the scenes and during a trend. So what do we have here in the red box? We have a strong selling period. We have a very steep decline over a short period, right? The market moves from here to all the way down here, very steep, and it doesn't take a lot of time. This green box, what do we have here? Here we have now a period of very weak buying. So in a period that is a little bit longer than this red box, the market did rose from here to here, but not much, obviously. You can see we didn't even come halfway into the previous highs. So what does this tell us? It tells us that there's probably a lot more selling here in this market behind the scenes, and the buyers are not really strong. They don't have a lot of say here in the market. So this tells us that markets is bearish overall. And at this point, you really don't want to look for buying opportunities. You really want to see and find out when are we continuing and going over to more selling. And this is the nice interplay that you often see between impulsive waves, which are also called trend waves, and corrective waves here. So when we look at it, what do we see? We are adding our weekly pivot point here, which is our long-term pivot and trend confirmation tool. And you can see here we are trading below the pivot point, and here we are retesting the pivot as resistance. This is a very, very strong bearish signal, and especially in this context, we also have the triple top. You can see here 1, 2, 3 times the market did try to break it, and this is the top. The market was never able to get above this. And you can see that this is all pointing towards selling, Nothing here says buying at all. There's not even a little bit hint that the market is strong here on the buying side. So we have to only wait for selling opportunities, which happen when we break out of the corrective wave. Here is then the break and retest entry. So we have the breakout, we come immediately back into it, and then here we have the rejection here. Stop area again, somewhere above the breakout area and above the highs. In this case, I wouldn't worry too much. I would probably put my stop loss somewhere here in the middle, and that's how I would approach it. You can see we have here another retest. The market did sell off, came back into it, retested our trend line from underneath. And that's why your stop loss should not be too aggressive, especially on a breakout, because after a breakout, the retests are very likely, and you want to make sure that your stop loss is protected from such a retest. And you can see we resume to what we have seen here initially, strong selling. So looking at trend waves and periods with the question in mind, who is stronger, buyers or sellers? And what do trend waves tell us is a very, very important way and very helpful way when it comes to understanding trend dynamics. The dead cat bounce is such a popular pattern, and this pattern has been in existence for over 100 years. You can even see it in the 1920s. When you look at the S&P, you can see it in Bitcoin, and it's such an important pattern. And what do we have here? We see, first of all, a very strong trending market, and then from this point to this point, and from here to here, and from here to here, you can see that each subsequent high is less far away from the previous one. So whereas from here to here you have a large distance, from here to here it's shorter, from here to here much shorter, and then from here to here we are pretty much almost not able to make a higher high at all. So that's our first sign of bearishness. We can also use a trend line to help us create a filter. So we can very nicely describe here this triple tap with the trend line. And what we have here is then the dead cat bounce. The dead cat bounce is pretty much just a break and retest. After the highest high, we move lower, we come back, and we're never able to even come close to the previous high. In here, this is your dead cat bounce. We make a low, come back, don't reach the previous high, and then you can see the market is selling off very strongly afterwards. Again, we can use pivots. We are using the daily pivots on the 1 hour, and you can very nicely see here is the tipping point. We use the pivots as support here, here, and here. We trade below the pivot point here for the first time. Here we are actively rejecting the daily pivot point. You have another corrective wave. If we remind ourselves about previously, what did we do here? Analyze waves. And what do we see here now? We see a very strong period of selling, and then here we see a weak period of buying. What does it tell us? It tells us we really want to look for shorts. At this point, I don't even want to think about buying. I only want to think about how can I get into a short, and the short entry is then occurring here after we get the breakout below the lows, which happened here, and then we fall off. And you can see this is such an important pattern to learn. It shows you how to spot trend reversals, how to get into continuation trades, and that's the perfect spot to trade because that's usually when the market moves the most in the shortest amount of time. And that's great for us traders because we don't have to hold trades for long and we can make a lot of money in almost no time. And I'm concluding with another fake out. And what do we have? We see strong buying here, then a very short amount of selling, very short corrective wave, then another push, and then the power dynamics really change. And you can already see if you have very long corrective waves, and if, especially relatively, if previously you had a short corrective wave and then suddenly the market is really struggling to continue, that's a sign of weakness. So the buying here that has gone on previously is now probably leaving the markets, taking profits, more sellers are coming in. The market is trying a last attempt here to make a breakout. And after the 1, 2, 3, 4, 5 tops here, we're seeing a breakout finally, but then within 3, 4, 5 candles later, we are back in the range. And that's where then we know, okay, this is a clear fake out. The bears are now probably in control. It's not 100% clear yet, but definitely you don't want to be buying. You want to think about, okay, what needs to be taking place for us to get into a short. And at this point, I would say we wait for a breakout here below 143.7. So if we get below this support area, that's a good place for a short, which happens here, stops again somewhere above here, either all the way above the pattern, out of the way, or a little bit closer. You definitely want to have your stop loss at least above here, the breakout area. And then you can see very easy for targets, you could use Fibonacci's, a fixed reward to risk ratio, general price action signals or highs and lows. If you see that the market is changing highs and lows, if you see that we are establishing a resistance or down here a support level, the market is not able to break through it, that could also be a good exit signal. And that's it. I hope you learned something. You can very nicely combine the different concepts of all the different strategies. You can add them to an existing strategy and you can use them in so many ways. Let me know how you like this video in the comments below. I look forward to hearing from you.